All right, let's dive right in. Today we're talking about one of the most important, non-negotiable rules of investing: diversification. It doesn't matter if you've been investing for decades or you're just getting started. Getting this concept right is absolutely crucial. So, to kick things off, I want to start with a question that gets right to the heart of the matter.
Seriously, ask yourself this. Think about your savings, your investment accounts. Is everything you've worked for riding on just one thing? It's that old saying, but it perfectly captures the risk we're going to break down today.
You know, we've all heard a story like this. Your friend gets a can't-miss tip on some hot new company. They go all in, pour their savings into it, and for a little while, they look like an absolute genius. The stock's going to the moon. But then, one piece of bad news, one market shift, and the whole thing just implodes. It's a story we hear all too often, and it's just devastating.
And that exact story is what we can call the one-basket catastrophe. It's the high-stakes gamble you take when you bet your entire future on a single roll of the dice.
And this number, wow, this really puts it into perspective. Just think about the math here for a second. If your investment drops by 90%, you don't just need it to go up 90% to get back to where you started. Nope, you need a 900% gain just to break even. That is brutal, and it's why this is so incredibly dangerous.
Now there's a fancy finance term for this danger: concentration risk. All it means is that when you tie your well-being to just one stock, one industry, or one asset, you're taking on a massive amount of risk that you have absolutely no control over.
Okay, so that was the scary part, but here's the good news. There is a simple, incredibly powerful, and time-tested solution to protect yourself from that catastrophe. And it's all about spreading that risk out.
And you can see the two paths right here, side by side. On the left, you've got the high wire act, the potential for huge gains, sure, but also for catastrophic losses. On the right is the diversified approach. Look, this isn't about avoiding risk, it's about managing it. Some of your investments might be up, some might be down, but the key is that no single failure can sink the whole ship. What you're aiming for is a much smoother ride over the long haul.
So how do we actually do this? How do you build that more stable portfolio? Well, you do it by using different building blocks. In the investing world, we call these asset classes.
So what in the world is an asset class? It's really just a big bucket for investments that are kind of similar to each other. Think of it like building a healthy meal. You wouldn't just eat a plate of bread, right? Of course not. You need some protein, some veggies, some healthy fats. It's the exact same idea for your finances. And this table breaks down the main food groups, asset classes. First up, you've got stocks. These are your growth engine. This is what's going to push your portfolio forward over time, but they can be volatile. Then you have bonds. Think of these as the shock absorbers. They provide stability and income, and often when stocks are having a rough time, bonds hold up better. And finally, you've got alternatives, things like real estate or commodities. These are great because they often move to a completely different rhythm than the stock and bond markets.
Now, I know this might sound a little complicated, but I promise you we can boil this all down to a simple, actionable blueprint. Let's just call it our 3-step plan to get this done.
Okay, step 1, it's all about you. You've got to figure out your own risk tolerance. How much of a market roller coaster can you handle without freaking out? Step 2, based on that, you choose your asset allocation. That's just the percentage mix. Am I 60% stocks, 30% bonds? And then step 3, you pick your actual investments. And this part is so important, you rebalance. That just means once a year or so, you adjust things back to your target. It forces you to sell a little of what's done really well and buy a little more of what hasn't. It's a super disciplined way to sell high and buy low.
And here's what that might look like in a picture. This is a super classic setup, sometimes called a 60-40 portfolio, with a little slice for alternatives. For a lot of people, this is a good, middle-of-the-road, balanced approach. It's aiming for solid growth without getting too crazy with risk.
But, and I cannot stress this enough, this is just an example. Your perfect mix is going to be unique to you. A 25-year-old who's got decades until retirement should have a very different portfolio than a 65-year-old who's about to start living off their investments. Your life, your goals, your comfort with risk, that's what drives the strategy.
Okay, one last critical piece of the puzzle. This isn't just about what you own, it's about how you think. Diversification isn't some get-rich-quick scheme. It is all about playing the long game.
I love this quote from Warren Buffett. It just hits the nail on the head. The market is going to have its ups and downs. It will throw tantrums. A diversified portfolio is designed to get you through those storms, but it only works if you have the patience to stick with it and not panic when things get choppy.
So let's just quickly recap the big ideas. Number 1, diversification is your number one defense against catastrophic risk. 2, it just means owning a mix of different types of investments. 3, you can get started with a simple 3-step plan. 4, rebalancing is the secret sauce to keeping your plan on track. And finally, the most powerful tool you have isn't a stock tip, it's patience. Think long-term. Which brings us right back to the beginning. I want to leave you with this final question to really think about. After all this, take an honest look at your own money. What does your portfolio's balance look like right now, and is it really set up to work for you?